U.S. electricity, record prices and output in 2025, what's driving the trends? Record-breaking energy use, soaring prices, and a heated debate over the future of America's power grid. If you thought 2025 would be business as usual for U.S. electricity, prepare to be surprised. The first half of the year has upended expectations, with a flurry of historic developments in power generation, pricing, and technology. But here's the twist: beneath the headlines, the real story may challenge what you think you know about clean energy and your monthly bill. From California to Kansas, the U.S. electricity landscape is being reshaped at a dizzying pace. Data reveals that between January and June 2025, the United States generated more electricity than ever before, as both demand and output soared to unprecedented levels. Several interconnected forces are propelling these changes: shifts in federal energy policy, a rapid ramp-up in renewable energy installations, and accelerating consumption by tech-hungry sectors like artificial intelligence, electric vehicles, and data centers. Let's break down the major trends that have emerged so far this year. A surge in clean power, yet fossil fuels still dominate. According to data from Ember, U.S. utilities supplied a staggering 2,188 terawatt-hours, TWh, of electricity during the first half of 2025, a 4% jump over the same period last year. This surge was powered, in large part, by a remarkable 32% year-on-year increase in solar generation and record-setting output from wind farms. Clean energy sources, primarily solar and wind, now make up 45.2% of America's electricity supply, moving up from 44.2% a year ago. That's a new milestone. For comparison, fossil fuel sources still provided 54.8% of the nation's power, with natural gas alone remaining the single largest contributor. However, after natural gas prices spiked early this year, generation from gas plants actually fell by 4% compared to 2024. This is the part most people miss. To make up for the dip in gas-powered output, utilities increased coal-fired generation by a striking 17%. Coal now represents 16% of total electricity generated, the highest level for the opening half of the year since 2022. Despite moves toward renewables, America's energy mix is still critically dependent on carbon-based sources, especially during periods of price or supply shocks. Rising electricity prices, more than just a clean energy story. If you've noticed your electricity bill creeping up, you're far from alone. Average retail power prices hit new highs, with customers in major U.S. cities paying an average of 18.2 cents per kilowatt-hour in the year's first half, according to the U.S. Federal Reserve. What's driving these increases? A multifaceted set of factors: robust electricity demand for everything from AC units to server farms, significant investment by utilities in upgrading the aging grid to handle bigger loads and integrate more renewables, and of course, the interplay between clean and fossil fuel generation costs. June 2025's average price per kilowatt-hour was 6.7% higher than in June 2024, outpacing overall consumer inflation by more than double. That raises important questions about affordability and policy choices. Are clean energy investments truly driving up costs, or are other factors at play? The blame game: is clean energy the culprit? Here's where it gets controversial. President Donald Trump has laid the blame for escalating electricity prices at the feet of his predecessor, Joe Biden, arguing that subsidized renewables are pushing costs up for consumers. Republican lawmakers have zeroed in on California's high electricity bills, citing the state's aggressive clean energy mandates as evidence that green policies are making life more expensive. They have even called for rolling back clean energy incentives in the national budget, asserting that these policies burden American households. But, and this is a crucial but, states with the largest renewable portfolios haven't consistently seen rising prices. In fact, some have experienced price drops from last year. For example, although California still tops the nation in average electricity prices, those prices actually fell from just over 32 cents per kilowatt-hour in 2024 to about 31.5 cents this year, per the U.S. Energy Information Administration. Similarly, states like Iowa, Kansas, and Nevada, all of which expanded their clean energy supplies this decade, have enjoyed year-on-year declines in consumer electricity prices. Meanwhile, states that have resisted clean power, like Florida, which bans wind power and limits support for solar, saw the average price climb by 5% so far this year. Indiana, Tennessee, South Carolina, and Wisconsin also reported above-average price growth. Interestingly, while average prices in these states are still below the national median of about 16.75 cents per kilowatt-hour in 2025, their slower adoption of renewables may put them at greater risk for future price increases, especially as the need for grid upgrades continues everywhere. Looking ahead, who pays for tomorrow's grid? Here's a potentially unpopular opinion. States rich in wind and solar may be able to put the brakes on future price hikes in the near term, thanks to the lower production costs of renewables compared to fossil fuels. However, regions without a strong clean energy base might have no alternative but to pass on higher costs to consumers, to both maintain their older fossil fuel plants and fund essential infrastructure upgrades. And as federal support for renewables faces potential cutbacks, those states may become even more exposed to volatile fossil fuel prices. So if coal and gas prices surge amid rising demand, who will foot the bill? The short answer, likely, the very households and businesses with the least access to affordable, clean alternatives. But what do you think? Is the push for clean energy unfairly blamed for high power prices, or do you believe the critics have a point? Could a focus on grid investment and innovation help lower bills in the long run? We want to hear your views. Share your thoughts or counterarguments in the comments. Asterisk note, the views in this column represent only the author's perspective. They do not necessarily reflect those of Reuters News, which champions editorial independence and neutrality. Asterisk. Enjoyed this analysis? Discover more cutting-edge insights with Reuters Open Interest, your go-to for global financial commentary. Follow them on LinkedIn and X to stay in the know about what's moving markets around the world. Study, Demand Policy, Tech Drive Energy Economy. The future of energy isn't just about keeping the lights on, it's about navigating a high-stakes transformation where every decision can have far-reaching consequences. The energy sector is at a crossroads, shaped by surging demand, evolving government policies, and rapid technological innovation. But here's where it gets controversial. Are utilities truly ready for what's coming next? A recent study by West Monroe Partners paints a vivid picture of this shifting landscape. According to their findings, the energy economy is being redefined by three main forces: the need to meet growing demand, the relentless pace of technological change, and the ongoing challenge of delivering affordable, reliable power. Federal regulations, state-level requirements, unpredictable weather patterns, and breakthrough technologies are all converging to push the industry into uncharted territory. The study, which surveyed 500 utility leaders across the United States in 2025, reveals some eye-opening statistics. For example, only a quarter of utilities have solid strategies in place to handle the massive new energy loads expected from data centers, a sector that's expanding rapidly thanks to our increasing reliance on digital infrastructure. And this is the part most people miss. While artificial intelligence, AI, is being hailed as a game-changer for optimizing energy systems and accelerating decarbonization, only 13% of respondents say they've seen a clear financial return from their AI investments so far. That's a surprisingly low number, considering the hype around AI's potential. Yet, optimism remains high. 3 out of 4 utilities are either already using AI or plan to adopt it within the next year, hoping it will help them meet ambitious sustainability and reliability targets. But public policy is a double-edged sword. While it can drive innovation and progress, it can also create hurdles, forcing utilities to juggle investments in new technology with the need to maintain stable, sustainable operations. Perhaps the most pressing challenge is happening at the grid's edge, where the integration of distributed energy resources, like rooftop solar and battery storage, is accelerating faster than many utilities can keep up. Only about 23% of utility leaders feel truly prepared to manage this shift, raising questions about the industry's readiness for a more decentralized energy future. Despite these challenges, nearly every utility surveyed, a staggering 97%, has set clear goals for transforming their energy systems, and 78% are feeling moderate to intense regulatory pressure to decarbonize. The stakes couldn't be higher, as the ripple effects of missteps can impact entire communities, economies, and even the environment. So, what do you think? Are utilities moving fast enough to keep up with demand and technology, or are they falling behind? Is the industry's faith in AI justified, or is it just another overhyped trend? And how should policymakers balance the need for innovation with the realities of reliability and affordability? Share your thoughts in the comments. This is a debate the entire energy sector needs to have. Where will USA EPS electricity generation come from in 2025? The future of U.S. electricity generation in 2025 is a hot topic that reveals much about the country's energy transition, and the numbers tell a fascinating story. According to the latest Short-Term Energy Outlook, STEO, released by the U.S. Energy Information Administration, EIA, earlier this month, the total electricity generated by the U.S. electric power sector is expected to reach 4,244.2 billion kilowatt-hours (BK) in 2025. But here's where it gets controversial. The mix of energy sources powering this generation is shifting, and the implications are significant. The EIA forecasts that natural gas will remain the dominant source, contributing approximately 1,696.9 BK, which accounts for about 40% of the total electricity generation. This reliance on natural gas continues to spark debate, especially among environmental advocates who argue for a faster move away from fossil fuels. Meanwhile, renewable energy sources are projected to supply 1,046.7 BK, roughly 25% of the total. This category includes a variety of sources such as conventional hydropower, wind, biomass, geothermal, and solar energy. It's important to clarify what the EIA means by renewables here. The solar energy figure, for example, only includes electricity generated by utility-scale solar photovoltaic (PV) and solar thermal power plants, those larger than 1 megawatt. Small-scale solar PV systems, like rooftop panels on homes and businesses, are not counted in this total. This distinction often surprises people who assume all solar power is lumped together. Within the renewable sector, wind energy is expected to lead, generating 472.8 BK in 2025. Solar power follows with 291.5 BK, and biomass contributes 20.5 BK. These numbers highlight the growing importance of wind and solar in the U.S. energy landscape, but also raise questions about the pace of growth needed to meet climate goals. Nuclear power is projected to be the third largest source of electricity, producing 783.8 BK, while coal is forecast to provide 702.6 BK, making it the fourth largest contributor. The continued presence of coal, despite its environmental drawbacks, remains a contentious issue. Petroleum-based fuels, including residual fuel oil, distillate fuel oil, petroleum coke, and other petroleum liquids, are expected to add 17.4 BK. Other fossil gases and non-renewable fuels, such as batteries, chemicals, hydrogen, pitch, purchased steam, sulfur, non-renewable waste, and miscellaneous technologies, are projected to contribute smaller amounts, 3.0 BK and 1.4 BK respectively. Looking back at 2024, the EIA reported that total electricity generation from the electric power sector was 4,150.9 BK, natural gas accounted for 1,759.2 BK, about 42%, while renewables made up 947.7 BK, around 23%. Nuclear power generated 782.0 BK, coal 648.2 BK, petroleum 14.5 BK, other fossil gases 2.8 BK, and other non-renewable fuels 2.5 BK. These figures show a slight shift toward renewables and a gradual decline in coal's share, but the pace of change remains a topic of debate. Looking ahead to 2026, the EIA projects total electricity generation will rise to 4,340.0 BK, natural gas is expected to contribute 1,726.0 BK, about 40%, and renewables are forecast to increase to 1,146.1 BK, around 26%. Nuclear power is projected at 800.2 BK, coal at 657.9 BK, petroleum at 14.4 BK, other fossil gases at 3.1 BK, and other non-renewable fuels at 0.2 BK. These projections suggest a steady but cautious transition toward cleaner energy sources. Interestingly, the EIA's previous STEO had slightly different numbers, projecting 4,237.0 bk for 2025 and 4,336.6 bk for 2026. Natural gas was expected to contribute 1,698.2 bk in 2025 and 1,719.7 bk in 2026, while renewables were forecast at 1,052.7 bk and 1,162.5 bk respectively. These small adjustments reflect the dynamic nature of energy markets and policy impacts. The EIA clarifies that the electric power sector includes utility-scale generating plants with capacities larger than 1 megawatt, operated by electric utilities and independent power producers whose main business is selling electricity over the transmission grid to the public. This definition excludes smaller-scale generation, which can sometimes lead to misunderstandings about the total contribution of distributed energy resources like rooftop solar. On its website, the EIA describes its mission as collecting, analyzing, and sharing independent and impartial energy information to support sound policymaking, efficient markets, and public understanding of energy's role in the economy and environment. It positions itself as the statistical and analytical arm of the U.S. Department of Energy (DOE), but importantly notes that the views expressed in its reports do not necessarily reflect those of the DOE or other federal agencies. This independence is crucial for maintaining credibility. The EIA proudly states it is the nation's leading source of energy data, and by law, its analyses and forecasts are free from approval by any other government official or employee. This ensures that the information provided is unbiased and based solely on data and rigorous analysis. So, what does all this mean for the future of U.S. electricity? Are we moving fast enough toward renewables, or is natural gas still too dominant? And what about coal and nuclear? Should they be phased out or maintained as part of a balanced energy mix? These questions are at the heart of ongoing debates about energy policy, climate change, and economic priorities. We'd love to hear your thoughts. Do you agree with the EIA's projections, or do you see a different path ahead? Share your views in the comments below and join the conversation.